Hello everyone, and welcome to the Söderberg & Partners January 2025 edition of our strategy report. Some of you may have heard previous strategy report presentations in person, and for others, I am looking forward to meeting you in the future to be able to present this to you in person. But for now, we are going to go over the strategy report in this video recording. And I hope you will all find some both enjoyment and some use of this presentation so that you will be able to present our view to your clients. For those of you who have heard our strategy report presentations before, you might know that we have a tendency of naming our strategy reports according to or by the names of popular songs. And this time we have chosen Harder, Better, Faster, Stronger by Daft Punk from 2001. We believe that this song both encapsulates what we see in the economy and that it's also driven by the advancements in AI and the productivity gains that we will see from these advancements. This particular picture also happens to be AI generated, so it is a theme going through the entire report. But for now, we are going to dig into the report, and as I said, I hope this will be quite useful for you. We will first start with our macroeconomic outlook, where we see a robust global growth. Starting with inflation, we have, obviously, for the past few years, have quite an issue with inflation, both in the US, in the UK, in the Euro area, in Sweden, where I live, and in many parts around the world. But what we're seeing right now is that we are starting to see disinflation. Inflation rates are approaching, at least in the West, are approaching the central bank's targets. We can see in the slide to the left here that in the US, the PCE or personal consumption expenditure measure of inflation is down to 2.4%. And this is the one that the Fed targets. CPI is at 2.9%, but this PCE measure is the one that's supposed to go down to 2% for the Fed to be happy. In the UK, we see CPI levels of 2.5%, and in the Euro area, the HICP inflation measure is at 2.4%. So we are approaching the central bank's inflation targets around the world. And what this means is that central banks are finally seeing some options to start cutting policy rates. And we have seen this happen around the world as well. In Sweden, where I live, central banks have cut by quite a lot. We cut the policy rate by 1.5 percentage points, or 150 bips, last year. And we are expecting more cuts ahead. In UK, you didn't get as many cuts, only 0.5 percentage points. But we believe, even though you have a slower road down to the inflation target, we believe that more cuts are ahead for you as well. And in the US, which is obviously quite important given our exposure to the US in the portfolios, I'm about to sneeze, I hope I don't, they cut policy rates by 1%. And of course, the policy rates is one thing that's quite important for several reasons. And one of the reasons is that it is important for consumers to actually be able to contribute to the economy once again. Because we believe that consumption will be key to the success in actually achieving, for example, a soft landing in the US. And we have seen quite different consumption numbers and consumer optimism in different parts of the world. So what we see in the chart to the left here is the optimism among the consumers compared to the normalized data. So the 0 point here is the historical average for consumer optimism. And what we see is that in the US, it has actually never for the past few years of high inflation, for example, been below the historical averages. So the average consumer optimism in the US has still been positive, despite being quite a large difference between a few groups of consumers being very displeased and then a few being able to handle the situation quite well. But in Europe, both in the euro area and in the UK, we have seen quite a different trend. So the consumer optimism here was almost 3 standard deviations below the historical average, which obviously is quite a large departure from the good numbers we are used to seeing. And in the UK, we had a short period where it turned positive, but now it's negative again. So sentiment indicators have improved by a lot, but they are still quite negative, whilst in the US they keep being positive. And in regards to this, when you have consumers being at least more happy than they were previously, this also tends to coincide with a lot more demand for things such as credit. And this is also, of course, tied to the lowered policy rates. So we see business credits starting to turn positive, or the demand for business credit, the demand for consumer credit as well. But obviously, the biggest change here that we can see is in mortgage credit. And since mortgages are one of the biggest loans you will ever take, if not the biggest, probably the biggest for most, it is quite a positive trend to see that this is actually improving. And we believe that this is one of the things that will be able to support GDP growth going ahead. And talking about GDP, to the left here, we have the IMF GDP growth projections for 2024 and 2025. We obviously don't have the final numbers for 2024 yet, despite being in 2025, and this is why we still have the projections. But what we can see is that we had a quite robust global growth last year, and we're expected to have that this year as well. The final numbers, as I said, are not in yet, but we're expected to land on a 3.2 percentage points GDP growth across the world, and 3.3% this year. And in the advanced economies, we are obviously being carried a bit by the US, which had a 2.8% GDP growth last year, and it is expected to have a 2.7 percentage point GDP growth this year. But what we can see is also that a lot of other regions are starting to see a bit of a comeback this year. So for the UK, for example, we're expected to grow from 0.9% GDP growth last year to 1.6% this year. But there are some risks to this quite positive GDP outlook, and one of the risks is what we see to the right. That is a trade policy uncertainty index, which is basically a measure of how much concerns regarding trade policy is mentioned in media. And what we can see, perhaps not to the surprise of anyone, is that it has spiked quite a lot since the election of last year. So since Trump took office and started throwing up threats of increased tariffs left and right, this index has shot through the roof. And this weekend we got the last trade war scare when Colombia didn't want to accept migrants that the US flew back to Colombia, and Trump threatened to increase the tariffs to 25%, and then the next week increased them by another 25 percentage points until they accepted the Colombian migrants. This situation has been resolved, but we can expect a lot more of this going forward. And I mentioned the central banks earlier, but we believe that central banks around the world will continue to cut rates. It's always hard to put an exact number on how much they will cut rates, but we see trends that should support continued disinflation, which of course will be enough for central banks to continue to cut rates. And one of the things that we see to the right here is the JOLTS measure of the US labor market of quits in the total or in the private sector in total. And this tends to coincide quite well with the inflation numbers, because when people are quite positive that they can get a new, more higher paying job, they are more likely to quit their current job. And this, of course, leads to wage inflation, which tends to coincide with a higher CPI number. But what we see right now is that the quits number in the JOLTS surveys are indicating that CPI should continue to fall. And with a falling CPI, we should also see a falling PCE, which, as I mentioned, is the Fed's official target number, and which tends to be hovering at around 0.5 percentage point lower than the CPI numbers. So if we see, for example, this CPI number go down to 2.5%, we are likely at or are very close to the actual target for the Fed. And with this background in the macroeconomic outlook, we are now moving ahead into our market view, which is obviously built up by our view of the macroeconomic outlook. And what we're seeing here is that AI has been the dominating theme for the past few years. We expect it to continue to be going forward, but we are also expecting a broadening of the market going ahead. But first, before we're talking about the equity market, we're first going to talk a little bit about the fixed income market. And what we're seeing is that rates are actually at quite attractive levels. And for this reason, we are not necessarily negative towards fixed income. We're just more positive towards investing in equities right now, because we believe that the conditions are even better for equities. Obviously, if you haven't seen it, I will show it later, but we have an overweight towards equities and an underweight towards fixed income. But we, in general, have a positive view on taking risk right now. And this flows through the entire portfolio, and you can see this in the fixed income part of the portfolio as well. So within fixed income, we are currently overweight credit risk, or overweight corporate bonds. We believe that they will be continually supported by a steady GDP growth. We believe that Trump policies may, at least in the short term, increase US demand, that deregulations and tax cuts should improve the business environment, which will lead to better ability for the companies to actually be able to pay off their debt. And we believe that rate cuts will continue to happen, which of course also should make it easier for companies to refinance and so on. And despite this, credit bonds or credit yields are at quite attractive levels. And we may see, at least in the very short term, some increases in defaults in the smallest companies, but not in the companies that are big enough to actually issue corporate bonds. So what we're landing in is that we are positive towards both investment grade corporate bonds and high yield corporate bonds, and we are negative towards government and mortgage-backed securities, because of course they are safer and have a lower yield. With that being said, we typically tend to advocate for government and mortgage-backed securities being the largest part of a fixed income portfolio as a standard measure. But our tactical view is that it is now currently a good opportunity to overweight investment grade and high yield corporate bonds and underweighting the government bonds. But with that, we are moving forward and looking at the situation for equity markets. And when we're doing that, we are posing a question of how we had impressive stock returns. And of course, I would say this depends quite clearly on where you turn your head. If you're looking at the US equity market, for example, we have certainly had quite an impressive year for the stock market, or impressive past few years, actually. But just looking at last year, we had a 27% gain in the S&P 500, in the total return index of the S&P 500, measured in Great British pounds. And if we're looking at another area that perhaps didn't have such an impressive return, we can look at Europe, the Euro Stoxx 600 index, which only returned 4.5%. So it's been quite a massive difference between the regions, and we don't believe the difference will continue to be this massive, but we do expect the US to continue to outperform and for Europe to continue to underperform. We obviously have a positive view on the US market, which I will show you later, and a negative view on the European market, which, as you can see by the chart to the left, was very, very good for our portfolios last year. But when we see this massive return in the US, it's no wonder that we see, for example, the PE ratios, which is a valuation metric for those of you that don't know, that it increases in the US. So right now we are above both 5 and 10-year averages in the US for the PE ratios. But we don't see an issue with this, and I will explain why. A lot of this has been driven by the tech companies, which have a lot higher earnings growth and therefore have a naturally higher PE ratio than a lot of other companies. And given that these high-tech companies with a very high earnings growth have become a bigger and bigger share of the index over the past few years, or over many years actually, this means that they are also a larger and larger part of the average, and since they have a naturally higher PE ratio, they are drawing the averages up. But we see that in Europe and in the UK, we are below historical averages for PE ratios. And at least looking broadly at Europe, we actually believe that this is justified because we have a lot of issues, both in the short term, but also structural issues when it comes to European companies actually being able to compete. If we're looking at the profitability, this is one of the measures that is actually supporting our positive view for the US. And as you can see in the chart to the left, the profitability measured as return on equity has historically always been higher in the US than in the rest of the world. But what we're seeing is that when we have a crisis in the US, as the global financial crisis of 2008, which obviously was set about by US issues, the profitability decreases sharply in the US, and it comes down to being just slightly above the rest of the world. But what we're seeing right now is that the profitability is a lot higher in the US than what we have in the rest of the world. And this also happens to be true in almost every sector, while as in Europe, the profitability is lower than the global averages in almost every sector. And this also affects earnings growth, which, as we can see by the chart to the right, has been very, very strong in the US and not quite as strong in Europe. This chart starts in 2012, so it's a bit over 13 years. And during this period, earnings per share have grown by around 157% in the US. And during the same period in Europe, they have grown by around 58%. And this is one of the things that makes us be quite negative, not only towards Europe or the euro area, but also towards the UK, at least when it comes to the equity market. Because looking at the FTSE 100, for the past 13 years, earnings have grown by only 24.6%, which obviously is not impressive numbers. And we believe that earnings growth will remain very important going ahead. The stock market tends to go where the earnings grow. So if we're seeing growing earnings, we are likely to see positive stock market returns. And if we're seeing negative earnings, then we are likely to see negative stock market returns. And as we can see by the chart to the left, for the past few years, earnings growth in Europe has been a lot lower than what it has in the US. And this is a trend that is expected to continue going into 2025. We are seeing a rebound in European growth, but it is only going up to 7.8%. And of course, these earnings estimates are by equity research analysts who cover the different companies. But in the US, we are expected to see 14% earnings growth, which is obviously a lot stronger than in Europe. And we are seeing other things that are expected to support the US market as well. What we're seeing in the chart to the right is the ISM, which is a purchasing managers index, and plotted against estimated earnings growths for the S&P 500. And what we're seeing right now is that the purchasing managers indexes are improving, which means that we could see support for at least this 14% earnings growth, perhaps even higher. And when it comes to earnings, AI has been the dominating theme, and it has been quite obvious, but others are starting to catch up. Last year, we had a 30 percentage point difference between the earnings growth for the Magnificent Seven and the other 493 companies on the S&P 500. But this difference is expected to shrink to 7 percentage points this year. The Magnificent Seven are still expected to be the main drivers of earnings growth on the S&P 500, but the difference is a lot smaller, and we're seeing a lot broader market actually being able to perform this year. And this supports our view in general that we are positive towards the IT sector and the communication services sector, but we expect to see a broader US market. And another thing supporting this broadening is the small caps in the US, where we're seeing things as small business confidence being a lot higher than what the returns on the Russell 2000 index are indicating. So small business owners are very, very positive towards the economic outlook, while the stock market hasn't really shown this yet. But we are expecting a broadening going into 2025. And if we are changing our view from developed to developing markets or emerging markets, we believe that it is still a bit too early for emerging markets to be able to perform. And one of the things that we can see is that, which the chart to the left shows, is that when the dollar is strong, which is when the pink line here is low, then that also tends to coincide with emerging markets underperforming developed markets. And for the past 15 years, we have seen a very big underperformance for emerging markets, over 400 percentage points underperformance. And obviously, emerging markets haven't dropped by 400%. It is instead the rest of the world which has performed very strongly. And since a strong dollar increases the cost of dollar-denominated debt, this is something that will pressure emerging market companies, given that they have a lot of debt that is denominated in US dollars. And we would also like to point out that quite often in our communication, you will hear that we are seeing a lot of opportunities, but also a lot of risks, both in emerging markets and in the Asia Pacific region, and Asia being a common denominator for both of these. So looking at Japan, which is the biggest part of the Asia Pacific index, and at China, which is the biggest part of the emerging markets index, last year we have events that show why we both see these opportunities and risks, and why we are typically for a neutral view in both of these regions. Starting with Japan, we had quite a positive return for the first half of the year in Japan, really strong returns actually. Then starting in July, we started seeing some problems and the stock market fell down a bit, but still had a very strong return for the year. And then in the start of August, we got some recession concerns in the US, not in Japan, in the US, which caused the Japanese stock market to fall by 20% in 2 days. A lot of this was then recovered, and almost this entire 20% drop had been recovered by the end of August, so within the month. But this illustrates that these markets can have quite volatile returns, and that it is therefore quite risky to stray too far from the index, both on the positive and the negative side when investing in these markets. And another example of this is China, where we saw some stimulus being launched, which meant that from the 9th of September last year to the 7th of October, so a period of 4 weeks, we saw the MSCI China index return over 39% in 4 weeks, measured in local currency. Because when this stimulus was announced, we saw a lot of optimism regarding that China might be able to crawl back from the slump that we're seeing to the left here. But then the details regarding this stimulus started to clear, and the stock market had to give back a lot, but obviously not all, of the returns that we saw in these markets. And the end result was that both China and Japan performed roughly in line with the world index. And what this means is that our neutral view on these regions actually turned out to be quite right. And with this, I am going to go over our allocation indicator, which is our entire market view summarized in just one slide. And what we're seeing here is that, as I mentioned in the beginning, we have a positive view on equities and therefore a negative view on fixed income. Within all of these boxes, our overweights and underweights need to balance out. So given that we are more positive towards equities than we are fixed income, we have an overweight equities and an underweight fixed income. But we do believe that both of these asset classes will be able to deliver a positive return this year. Within the fixed income segment, we are positive towards taking more risk and are therefore overweighting both corporate investment grade and corporate high yield bonds. And we are instead underweighting and have a maximum underweight on global government bonds. Within the global regions, we do prefer North America over Europe. And this is given by the fact that we believe earnings growth will be a lot stronger in the US than in Europe. We believe the profitability will continue to outperform in the US. And we also believe that Trump's policies will be a lot more positive for US companies than for companies in the rest of the world. We, in other markets, have generally a neutral view, but within the Asia Pacific region, we do tend to prefer Japan, which is a bit more technologically advanced than some of the other countries. And looking at the global sectors, we have a positive view on IT and communication services, which is where we are seeing this AI development, and we are currently underweight to consumer staples and financials. And our negative view on financials hasn't been right, at least so far. This is something that we, of course, want to acknowledge. We believe that lowering interest rates would hurt financial companies, and it has to some extent, but not to the extent that we expected. And other things such as M&A activity has been able to support the banks despite lowering interest rates somewhat hurting them. So this is, of course, something that we will continue to watch going forward. But in general, this view has been quite right for the past year. We have made some changes along the way, but things such as the overweight in equities and the overweight in North America has been positive. And we will continue to update you when we release new strategy reports and whenever we decide to make changes to our allocation indicators. But with that, I would like to thank you all very much for your attention. And as I said, I hope this has been quite useful and that I will see you all soon. Thank you and goodbye.